Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. So President Trump is back for another 4 years, and the Republicans gained a majority in the Senate while likely keeping control of the House as well. This red sweep might make it easier for Trump to get his key policies through, which are centered around tax cuts, deregulation, energy independence, trade tariffs, and tighter restrictions on immigration. These policies could impact everything from inflation and interest rates to the types of companies that are best positioned for a reshaped economy. So in today's video, I'm going to review 7 high dividend stocks with yields up to 10% that could enjoy a Trump bump in the years ahead. But before I review these stocks, I want to be clear that I don't believe long-term investors should make any stock trades in their portfolios that are driven only by election outcomes, because it's just not that simple. If we turn back the clock to 2016, Trump's odds of winning were only around 20% heading into the election. After his victory shocked the world on November 8th, the best performing stocks that month were in the financials, energy, industrials, and basic materials sectors, as investors scrambled to bid up companies that would benefit the most from stronger economic growth and higher interest rates and inflation. We're seeing that trade play out again today. I put a few hundred dividend stocks of average or better quality into a portfolio on our website, Simply Safe Dividends, so we could see their one-day price move right after Trump was elected. And it's very similar to 2016. You can see the biggest winners here were mostly banks in the financial sector here. A lot of them are smaller banks as well, up about 10-15%. You can also see as we go down, there's some construction companies here. There's also going to be some energy stocks involved in oil and gas production and the midstream space. So really, you're seeing this bet on cyclical stocks, banks, energy, some industrials here. On the losing side, there's a few companies that reported earnings in here, like Scott's, which is one you can just ignore. But the main theme you see here is, bets against renewable energy. A lot of those stocks were down big. And then also some of the bond-like stocks like REITs, Staples, those companies were kind of sold off as yields rose and people rotated more into cyclical stocks that could benefit from stronger economic growth. However, the market's knee-jerk reactions don't always age very well, and that was the case in 2016. Of the 5 sectors that initially outperformed the market that November, only the consumer discretionary sector did better than the S&P 500 for the nearly 4 years until COVID hit. Tech was the biggest winner but was largely ignored following Trump's 2016 win. You really can't make any blanket statements about which area of the market will do best under a certain president. This chart covers a much bigger sample size going back to 1976 and shows whether each sector outperformed or underperformed in election years, with the blue and red boxes indicating if a Democrat or Republican was elected. The takeaway is that there is no clear connection between a sector's outperformance and who is in office. The final big picture point I'll make is that long-term investors should remain invested no matter who wins. Staying in the stock market only when a certain party is in office has been about the worst thing you can do, as this chart from Invesco shows. The tiny lines at the bottom are the relatively small returns you would have earned if you only invested during Democratic or Republican administrations. That said, let's look at some companies that could benefit from another 4 years of Trump, but seem likely to be durable businesses over the long run regardless of who's in office. The first high dividend stock I'll spotlight is First of Long Island. This community bank is quite small with only around 40 branch locations, but it has been in business since 1927 and paid reliable dividends for over 30 straight years. Trump is viewed as good news for the banking sector because his policies would look to reduce their regulatory burden and compliance costs while giving them flexibility to operate more freely and take on more risk. Trump's policies are also expected to lead to a stronger economy and higher long-term interest rates, which increase banks' net interest margin, or the spread between the interest they earn on loans and what they pay on deposits. That's been a challenge in recent years for First of Long Island and many other smaller regional banks, which have had to pay their depositors a lot more interest to keep their business while the Fed hiked rates aggressively. Some faster relief here would help restore the bank's profitability and dividend coverage. Outside of this squeeze, First of Long Island maintains strong capital levels and has a long history of solid credit performance. Investors just need to be comfortable with the firm's less diversified business mix and its geographic concentration in Long Island's commercial real estate market. Shares are up 12% following the election outcome, but they still look cheap compared to where they'd trade if the bank's dividend yield returned to its 5-year average. Next up is CrossAmerica Partners, which is a small cap MLP that distributes over 1 billion gallons of motor fuel annually to 1,800 gas stations and other locations. The company's operating income is balanced between its fuel distribution business and its retail segment, which makes money from leasing convenience stores to tenants and operates some of its own gas station locations. Trump's desire to increase America's energy production could lead to lower and more stable gas costs, which could boost CrossAmerica's fuel volumes as consumers take advantage of cheaper prices at the pump. Convenience stores would also benefit from more consumer traffic since they could sell more snacks, beverages, and other everyday products. Deregulation could help CrossAmerica as well since the company has faced higher costs in the past from regulatory compliance issues. Either way, CrossAmerica offers a 10% yield that is well covered by the firm's cash flow with a payout ratio near 75%. While there's little volume protection in this business, demand for gasoline is usually stable, and when volumes do decline during economic slowdowns, the company's margins can still rise since part of the business has variable fuel margins, which increase when the price of oil falls faster than retail fuel prices adjust. It's also worth noting that the firm's founder and chairman Joe Topper owns and controls CrossAmerica's general partner, and he presumably desires to keep a generous dividend policy in place. Brookfield Infrastructure Partners is our next potential Trump beneficiary and is a master limited partnership that yields about 5% and seems likely to keep growing its payout at a mid-single-digit clip going forward. If you don't like MLP since they issue a K-1 form at tax time, Brookfield also offers a corporation version of the stock that has the same economics but trades under the ticker symbol BIPC and sends a 1099 form. So how does Brookfield make money? The company owns a diversified portfolio of infrastructure assets, including electrical transmission lines, railroads, ports, natural gas pipelines, toll roads, telecom towers, and data centers. This is a really durable business since about 90% of Brookfield's cash flows come from regulated sources or long-term contracts, and around 70% of the firm's cash flow also has no volume risk. Most of Brookfield's customers have investment-grade credit profiles, which makes them reliable counterparties. And besides one utility company, no customer tops 10% of sales, which helps diversify risk. Trump's business-friendly policies and his desire to increase infrastructure spending could open up more investment opportunities for Brookfield as companies put more priority on their U.S. operations. A recent example was a joint venture BIP created with Intel to invest in American-based semiconductor manufacturing facilities. Rising investment in artificial intelligence is also fueling a massive build-out of power-hungry data centers that should create more opportunities across Brookfield's data, electric utility, and natural gas sectors as well. Overall, we give Brookfield a safe dividend safety score in recognition of its annuity-like cash flow and its diversified portfolio of essential long-life assets. The firm also earns a BBB+ credit rating from S&P. We're going to head to the energy patch next with Kinder Morgan, which is one of North America's largest midstream infrastructure companies with a sprawling network of pipelines, storage facilities, and terminals that are integrated into practically every major gas and oil shale formation in the country. Trump wants to prioritize domestic energy production to reduce America's reliance on foreign sources and help fight inflation by keeping oil prices contained. Kinder Morgan's assets could enjoy stronger utilization if drilling activity rises in the years ahead, and it's insulated from lower energy prices since most of its cash flow is generated under fee-based take-or-pay contracts for periods of up to 20 years. Artificial intelligence is another surprising driver that could continue seeing nice advancements under Trump, and it could also benefit Kinder Morgan since natural gas pipelines generate most of the firm's revenue, and gas is expected to be one of the main energy sources to power new data centers in the years ahead. Management has stated that there are already data centers looking to connect to Kinder Morgan's system, and management believes that AI could boost incremental natural gas demand by about 3% to 10% by 2030, which may not be a big needle mover, but it could nudge utilization of Kinder's assets higher over time. These tailwinds combine with Kinder Morgan's predictable cash flow, healthy dividend coverage, and investment-grade rated balance sheet to make us comfortable giving the company a safe dividend safety score and maintaining expectations for low single-digit dividend growth going forward. Next up is MSC Industrial, which distributes metalworking products and supplies used in maintenance and repair projects. So think of things like cutting tools, fasteners, janitorial supplies, and power tools. Trump's desire to lower taxes, impose tariffs on imported goods, and reduce regulatory burdens all encourage bringing manufacturing back to the U.S., which is where the majority of MSC's business is based. A more favorable economic environment for domestic manufacturing would presumably bode well for many of MSC's customers, resulting in higher demand for its products. It's also worth noting that Chinese products were only around 10% of MSC's cost of goods sold a few years ago, so the company is hopefully more insulated from Trump's tariffs, even though it has to source a lot of products from many different suppliers to run its business. While MSC has underperformed in recent years due to both cyclical headwinds and some execution issues, the firm has paid reliable dividends for over 20 years and seems likely to get back to mid-single-digit dividend growth in a couple of years. MSC also has less than 5% share of the North American market for industrial distribution, so it should have a long runway to continue consolidating this fragmented space well after Trump's term is up. We'll next look at Evergy, which is a regulated utility that has provided electricity to customers in Kansas and Missouri for more than 100 years. The utilities sector fared relatively well during Trump's first term, and his ongoing push for deregulation could reduce compliance costs for these essential companies. Evergy could especially benefit since it has a higher dependence on fossil fuels to generate its power. Coal accounts for about 40% of its fuel capacity, and natural gas and oil contribute around 25%. That might explain why Evergy's shares outperformed the broader utilities sector by about 1% the day after the election, even with yields rising, which has kind of softened investors' appetite for these bond-like stocks for now. Regardless of any relief on the regulatory compliance side, Evergy is seeing demand for electricity growing 2 to 3 times faster than normal around the Kansas City area, thanks in part to both Google building out a massive data center and Panasonic constructing an electric vehicle battery plant. Trump's efforts to double down on onshoring and supporting U.S. manufacturing could provide further commercial demand tailwinds and help Evergy deliver mid-single-digit earnings and dividend growth over time, which would extend its streak of making higher payouts for 20 consecutive years. We think the utilities dividend remains on solid ground. It's given us confidence to assign Evergy a very safe dividend safety score, which indicates a very low risk of a dividend cut over a full economic cycle. It's also worth noting that the firm earned a BBB+ credit rating from S&P. That said, regulators in Kansas granted Evergy a smaller rate increase than it had hoped for in 2023, which slightly reduced its growth outlook and caused shares to trade at a discount to the utility sector. Investors prefer utilities that operate in states with constructive regulatory environments, so this discount could persist in the intermediate term until something changes. But even if the regulatory outlook doesn't improve a whole lot from here, Evergy offers a safe 4% plus yield that should keep growing by around 5% per year. Last but not least, Genuine Parts was founded in 1928. This company distributes automotive and industrial parts that are primarily needed to repair or maintain vehicles and equipment as they break down over time. The company has built a loyal following of customers like mechanics by giving them quick access to quality replacement parts through its large distribution network and its inventory breadth. Selling recession-resistant products never hurts either and has made it easier for Genuine Parts to grow its dividend every year since 1957. Despite this track record, though, the stock is down over 10% this year and trades near a 52-week low after reducing its guidance last month. This was in response to softer demand in Europe and in industrial markets. We don't think those challenges impact the company's long-term outlook, and we've maintained our safe rating on the firm's dividend since the company still maintains a healthy payout ratio near 50% and has a solid balance sheet that earns a BBB rating from S&P. If Trump's efforts to accelerate economic growth and revive U.S. manufacturing are successful, Genuine Parts could benefit since it derives around 70% of its sales in America with a focus on old economy applications. Either way, this is a time-tested business offering a higher yield than usual and that has long-term dividend growth potential, probably in the 4 to 6% type range, as it works to keep taking share in its fragmented markets. I hope this video gave you some helpful perspective on how to think about presidential elections, as well as a few interesting ideas to consider. If you enjoyed it, it would really help support me if you liked the video and subscribe to our channel to get ongoing dividend stock analysis and some income investing tips, usually about 2 to 4 videos a month. If you have your own dividend portfolio, you might also want to check out our website, Simply Safe Dividends. Makes it really easy to keep your retirement portfolio between the guardrails with our dividend tools and research, including a portfolio tracker, dividend safety scores, a stock screener, newsletter, company analysis pages, and a lot more. The site is free to try and it only takes a minute to get signed up. I'll drop a link in the description below. Thanks again for watching, and I hope to catch you next time.